Hi, I'm Jerry Bowyer. You're watching the Eagle Investing Network. Thank you for watching, and I thank you in advance for hitting the subscribe button, or I thank you if you've already hit it. And I would also thank you if you went out and shared this video with other people that you think might benefit from the knowledge. You ever thought that maybe people don't know enough about economic and finance? Maybe like your family, for instance, doesn't. I hear a lot of people complain, kids don't understand the basics of finance and economics and investing. Well, kids like YouTube, send this to them and encourage them to subscribe. Okay, let's look at some investment data. This is advanced stuff, but put in a way that's easy to understand. That's how we do it here. Highly advanced finance in easy to understand terms, and so far, always under 10 minutes. You can spare 10 minutes to learn highly advanced finance, can't you? All right, if you watched my last video, you've seen this chart before. We're going to ignore this part. This is corporate bond yields. We didn't ignore it before. We looked at it. We learned a lot. We're going to continue to look at this part. This is Treasury bond yields. What's a yield, you say, Jerry? I forget. You mentioned it last time. A yield is the interest rate divided by the price you pay for the bond. And so when the prices are going up, the yields are going down. And when the prices are going down, the yields are going up. And these are Treasury bonds. Just so happens it's 10-year Treasuries, but 5 years have acted pretty similar too. What's this down here? These are TIPS. What are TIPS? Treasury inflation, emphasis, let's the I, the inflation protected securities. These compensate you for inflation. So let me explain how this works. How do I get compensated for inflation? Well, if you lend the federal government $100 in the form of a bond, let's say it's 1 year. You don't actually call them bonds, but it's 1 year. But let's just treat it that way. Well, you lend the federal government $100 in the form of a bond. Typically, you give them the $100. They pay you interest. And then afterwards, they give you your 100 back because they didn't take it. That's what they do with taxes. They borrowed it. That's what they do with bonds. But this kind looks and says, well, there's been 5% inflation since we borrowed the money from you. So we're not going to give you $100. We're going to give you $105. They compensate you when they return the principal, which means that you don't need compensation for inflation in the interest amount. The inflation risk doesn't show up in the yield because it's already covered when they pay you back the original principal. So let's go back to the data, which means that the difference between these two yields is based almost entirely on what you expect inflation to be. There's another little super advanced topic. A little bit of this difference is what's called a liquidity issue, a liquidity premium. And what is that? TIPS are a little more confusing than regular treasuries, so people are a little bit more likely to avoid them because the math is a little more confusing, which means the price is a little lower than it would have been, which means the yield is a little higher. Maybe we'll do just a deep dive on nothing but that highly complex issue. But just here's the take home. The take home is that these TIPS, these prices are always going to be a little lower, and the yields are therefore always going to be a little higher, as long as people find TIPS a little bit confusing to invest in compared to treasuries. Doesn't make a big difference. I've looked at the math. So what are we going to look at here is the spread. So if treasury bond yields are going up, I don't want treasuries. Why don't you want treasuries? Well, this says I don't want treasuries because I'm buying corporates because I think the economy is improving. Going up, going down. That's narrowing. I don't want treasuries. Apparently you wanted TIPS. Why? You're buying TIPS because you're afraid of inflation. So as this spread is increasing, that's inflation risk expectations. So we're going to make this a little simpler because I know there's 3 lines there, and I'm asking you to kind of look at the spread between the red line and the green line, what that difference is, and kind of keep track of that. And that's a lot to keep track of. So we've done it for you. You're welcome. We're going back and we're seeing this is the spread. This is the difference between those bottom 2 lines. So 2008, that is a deflationary signal. By the way, that was wrong. We got high inflation in 2009, but that's what markets thought at the time. And what we have here is really 2018, but especially after COVID, inflation expectations were rising. Now, this is inflation expectations. This is what markets are doing based on what they think is going to happen. Actually, right here, the economy was deflationary. The economy was having actual deflation here. But I can tell you, I was doing a lot of briefings, and what I was saying is what the government is doing now to fight the deflation, what the government is doing to fight this crisis, is sowing the seed for the next crisis. So the government was creating a lot of new money to get out of that deflationary hole. They created too much new money. So they got out of one jam, they got out of a deflationary jam by creating another jam, which is an inflationary one. Let's go back to the data. So the markets were signaling this around this time. The Fed was saying inflation, no. You know what? Me worry? Alfred E. Newman, economists, and a lot of pundits were too. But of course, inflation really was a risk. These investors knew it, and it continued to go up. Now, I'm not going to go back to that last chart, but actually it's dropped a little bit this year. And so what we're seeing here is that inflation risks are elevated compared to history. The Treasury and TIPS yields have shown us that. That problem has gotten a little better, but not back to normal, so it's still a problem. Generally, these markets have been right, although not perfectly. When you make the proper adjustments, they have about an 80% correlation with future inflation, so you would ignore them at your own peril. This market is signaling inflation is not going away, and all of us, no more than some of us, especially the some of us who work for central banks and who depend on keeping people calm rather than accurately predicting the future. So inflation's a risk, and TIPS are one of the ways that people have been able to fight that, and this is your introduction to TIPS. It's something that people are going to have to know a lot more about going forward as we're entering a probable age of inflation. All right, I'm Jerry Bowyer. You've been watching the Eagle Investing Network. As always, I urge you to subscribe. It's for your own good. And then you'll know when these videos are coming up rather than having to say, hey, I haven't watched one of those Eagle Investing videos from Jerry Bowyer in a while. You subscribe and it tells you that there's a new one available. Also, share these videos with someone else who you think might benefit. Thanks for watching.